that over the next few years, our growth will continue to remain really, really healthy. Between FY23 to FY25, we were growing at about 32.5% CAGR. This year, in the first half, we have grown 68% CAGR or 68% year on year. So our view is that our healthy growth is going to continue, and that is why some of these capex enhancements are going to really fast track and make us reliable and more customer oriented.
Metal markets are blistering hot with gold, silver, copper and tin scaling fresh highs. This is after investors poured into hard assets amid rising geopolitical tensions and bets on future Fed rate cuts. Safe haven demand helped gold and silver hit record peaks, while base metals like copper continue to benefit from supply concerns and strong industrial demand. My colleague Shreyansi shares all the reasons and the impact of all the geopolitical developments on commodities in general. Shreyansi.
Well, absolutely, and you're taking a look at a bunch of record highs coming in, because you're looking at gold, silver, copper, tin, all of them hitting record highs just today. And let's talk about some of the key triggers. Before we do that, it's actually tin that is the standout when it comes to base metals, surging about 6% in trade as well. Other than that, you do have investors betting on a boost coming in from lower interest rates that actually increase the opportunity cost of holding bullion as well as the white metal, that is silver. Other than that, you do have a debasement trade that is at play, and that's important because investors are avoiding government bonds and currencies due to those worries around the debt levels, and that's something that you're looking at in terms of a key trigger coming in. There's also investors focusing on a revival when it comes to China, and you're looking at that trade surplus of about $1.2 trillion in 2025, and that's a key trigger when it comes to gold and silver. In terms of the other triggers when it comes to silver, of course, there's geopolitical risk premium that you're looking at. And there's also tariff fears, because you do have a very important judgment that we're waiting by for, and that could actually be introducing a few tariffs when it comes to the white metal to the mix. On the back of that, silver was buzzing away in trade, soared past that $90 an ounce level for the first time ever. And you do have supply concerns, of course, lingering as far as silver is concerned. It's also overtaken Nvidia's market cap. So you're looking at $5 trillion in market cap when it comes to silver, trailing behind after gold, with that $32.1 trillion in terms of the market cap as well. Lastly, when you take a look at some of the trading volumes, they've actually been high when it comes to COMEX and even Shanghai futures. So that's something that you're looking at in terms of trade as well, in terms of kind of volumes that you've seen coming in. And Brent has also cooled. Oil, in fact, has dipped near those $65 per barrel levels when you talk about Brent crude. And that's something that you've seen playing out in terms of oversupply fears, actually offsetting some of those concerns around Iran as well.
Thanks so much for that. And viewers, that's all the time we had on this edition of Profit 360. But do stay tuned to NDTV Profit as we continue to bring you a lot more news and updates. This is Malika Mishra. Thanks so much for watching.
The first Indian news channel at the World Economic Forum at Davos. 21 years at the heart of the world's most influential dialogue.
Continuing to make sure that the poorest are not forgotten.
Big enough, brave enough, bold enough to face the critics.
We've been doing more and more improvements.
We are the fastest growing amongst the major economies.
Both of us are interested in these.
Young girls aren't in school because they're scavenging for water for the family.
We need to get out of the way and into the work of breaking open access for each and everyone.
Now, India's most trusted news network returns to the Alps with its most formidable editorial voices. NDTV Ignite at Davos.
Well, we are on this budget yatra, and we are in the midst of a solar field, and we are at the KP Group's facility in Sudi in Gujarat.
At the Biswa Bangla Gate, New Kolkata meets old industry. From Century Ply to Titagarh and Berger Paints, the message ahead of the budget is clear. Growth needs clear policy support.
NDTV Profit is in Indore, India's cleanest city. But in store, we are going to look after Indore's nightlife, what are the industries, and of course, the industry's budget expectations.
NDTV Profit has travelled all the way to Lucknow. This city is known for its delicious Awadhi food. This city is known for its tehzeeb, and this city is known to be one of the top 5 GDP contributors to India's development.
Budget for Bharat travels to the city of Bengaluru, a city which has given us so many innovators, so many startups. I'm spending time in a startup hub to get a pulse of the city and to find out what the startup founders want from the finance minister.
Coimbatore, a pretty big city in Tamil Nadu, known for industry, known for its textiles and also filter coffee. It's been called the Manchester of South India for a reason, and that's because of spinning and because of textiles. I've got Saurabh Mukherjee as well as Nandita, who is the economist at Marcellus, and we're actually going to be going to a few places over the course of the day.
A very special moment for us as we announce NDTV Master Stroke, the NDTV Art Awards.
NDTV presents the Master Stroke Art Awards, an odyssey of creative brilliance where the masterpiece meets its ultimate recognition.
NDTV bringing this subject forward would have a great integrity of putting it forward where people could understand the importance of art.
This award that is being started, I'm sure is going to be amazing.
Art for India and for Indians is an expression of our Atmanirbharta.
It's actually quite a formidable jury, so I think we'll reveal a lot more as we go along.
This is an amazing platform, I think, today what you're doing.
Honoring the masters who define our creative landscape. Coming soon on the NDTV network.
Alright team, our new order show is ready. Now we need a promo. Something cool, something sharp.
Well, I'm sure we'll be having outstanding reviews, solid suggestions,
Expert advice, the latest trends. It's a lot simpler. We'll help people make the right auto decisions. It's got the cool stuff, geeky stuff, serious stuff, all of it, so that you can discover, decide and drive. I'm Siddharth Sharma and I am your Automate.
New year, new power panel, India market open, now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock, with a table-thumping buy.
And when the street wants the levels, he brings the chart.
Charts speak the truth, and I deliver the levels with no frills.
Parag Thakkar.
Hello and welcome to KYC. I am Sharad Dubey and you are watching NDTV Profit. Let's start the show. In KYC, I'll be giving you some hints before we disclose the company. And the first hint is the company is making precision engineered products. This can be aero, can be metallurgy. These are the hints. The second hint I would like to get is the delivered air.
The media team is as well. Good afternoon, everyone, and thank you for being here. Warm wishes for the new year to all of you. We've had a strong performance in Q3. Our revenue grew 0.6% sequentially and 1.7% year on year in constant currency terms. Our large deals were at $4.8 billion with 57% net new. This was across 26 deals. Our adjusted operating margin was 21.2%. We generated free cash flow of $915 million. One of the most significant large deals we won was with the National Health Service in the UK. This $1.6 billion deal expands our work in the healthcare sector. We will help NHS leverage AI to streamline operations and improve patient care for UK citizens. We have deepened our Topaz AI capability with an agent services suite called Topaz Fabric. This suite helps our clients manage and implement AI agents across the enterprise. We had strong momentum in AI adoption across our client base. Today, we work with 90% of our largest 200 clients to unlock value with AI. We're currently working on 4,600 AI projects. Our teams have generated over 28 million lines of code using AI. We've built over 500 agents. We're scaling our forward deployed engineer team. We are now witnessing 6 AI-led value pools emerging that could unlock a large incremental opportunity. We also see productivity-led benefits that compress some legacy areas. The 6 large AI-led value pools are AI engineering services, data for AI, agents for operations, AI software development and legacy modernization, AI deployed in physical devices, and AI trust and risk services. We believe we are uniquely positioned to capture market share across these value pools and emerge as the leading AI value creator for global enterprises. We will share a comprehensive view of our approach at an investor day later this quarter. With a strong performance in this quarter, we have revised our revenue growth guidance for the financial year. The new revenue growth guidance for this financial year is 3% to 3.5% growth in constant currency. Our operating margin guidance for the financial year remains the same at 20 to 22%. With that, let's open it up for questions.
Thank you, Salil. We will now open the floor for questions. Joining Salil is Mr. Jayesh Sangrachka, Chief Financial Officer, Infosys. The first question is from Ritu Singh from CNBC TV 18.
Hi, thank you. And Rishi, sorry, this is our only chance to speak with the management every quarter, so we'll have to exceed that one question limit. With that, Salil and Jayesh, to begin with, I wanted to start with your headcount number. We've seen an increase of 13,246 over just the last 2 quarters. And this is interesting because it's coming at a time when your peer TCS is cutting 30,000 jobs. How should we read into this? I mean, is this a real indicator of how you see the demand environment improving? And with that, I wanted to get to your guidance figure being raised to 3 to 3.5%. How much of that upgrade is because of large deals like NHS being factored in? How much of the Versant acquisition, which is yet to be completed, as we understand, is baked into that number? And because last quarter you were telling us, for instance, there are segments like retail that remain the weakest link. So where are you seeing improvement that has led you to upgrade your guidance? That's one. Also, sequentially, we've seen a very light, bit of a marginal dip in your margins, that is to 20.8. This is at a time when, there are tailwinds emerging from the rupee depreciation. So if you could break down why that has been the case, and while you continue to tell us about how you're uniquely placed to, exploit that AI opportunity, and, the likes of HCL Tech and TCS have been giving us concrete numbers, why does Infosys refrain from doing so? Thank you.
So let me start, I think, on margin. Jayesh might have some points. I think the first part I missed a little bit. It was the headcount increase, right? Yeah. So on the headcount increase, I think it demonstrates that we have confidence in where the market is, what we are seeing in terms of the demand. And that also feeds in a way, to the second point you had in terms of how are we raising the guidance, the growth guidance. So first, in terms of the growth guidance, we are just finishing the 3rd quarter, so only 1 quarter is left. So this, we have had a lot of large deals in the previous few quarters, plus we had a very strong execution in this quarter. We have also seen, you asked a little bit about the industries. We've seen, for example, in financial services, and we've seen in energy, utilities, resources, services, we see that the way the deals have come, the way we have become AI partner of choice with our largest clients, we see a good outlook even as we look into the next financial year. And that's in part helped us to increase the guidance, which is only for this financial year, which is for ending in March at the end. On margin, you want to?
Yeah, so first of all, very happy New Year to all of you. Before I come to margin, I just wanted to also touch upon the headcount part. If you recollect, last year we had called out that we are going to hire 20,000 freshers this year, right? And we have onboarded roughly around 18,000 freshers, and we are well on our way to, finish our 20,000 number for this year, which in a way reflects in our headcount also, because many of them are under training. And if you look at, our utilization, including trainees, has come down. So that is our investment into building capacity for future in a way, right? So that's on the headcount. If you look at margins, we have expanded our margins this quarter by 20 basis points versus the last quarter. We are now on a 9-month basis at 21% margin, which is midpoint of the guidance that we have given. The puts and takes of 20 basis point expansion this quarter is 40 basis points came from currency. 50 basis points came from the Project Maximus, mainly on account of value-based selling and the lean and automation that we have done on multiple projects, offset by the furloughs and working day that we had. We also accrued a higher variable pay compared to last quarter, which was offset by some of the one-offs that we got. So that's the broad margin work in a way. But if you look at a 9 months period margin, which is 21%, we have invested in our sales and marketing, which has gone up by 50 basis points on a year-on-year basis. So that has been absorbed in the margin. The lower utilization, of almost 1% has been absorbed in our margin. So this margin is after absorbing all of that, where on one side we are building capacity for future, on the other side we are investing in sales and marketing, and we still had a stable margin from that.
Do you have an outlook for next year now that you're completing this 20,000 for the year? You've had a lower attrition as well this quarter.
We will have an outlook, once we give our guidance for next year in April.
And also the wage hikes, what's planned for the year and what kind of impact that could have on the margins from here on?
So we just finished one cycle of our wage, which was in 2 parts in January and April. We haven't yet decided on the next part yet. We will decide on that as we progress.
Yeah, on AI, I think one of the points I shared, and we have a lot of that sort of information, was with our largest 200 clients, with over 90% of them, we are doing AI work. What we are doing in AI is unique AI services with clients, and also we've reshaped all of our existing services leveraging AI. And for example, we are using agents in several of our service lines to help enhance either growth or productivity. So that's what we are sharing in terms of what our impact is.
Thank you, Ritu. The next question is from Mansi Dave from ET Now.
Good afternoon, Salil and Jayesh. This is Mansi Dave from ET Now Swadesh. My question is on demand visibility, tech spending, and AI adoption. Now, looking at the constant currency growth scenarios and commentary around fewer billing days and deal timing, how are clients thinking about calendar year 2026 tech spending, especially discretionary versus transformational-led programs, and at the same time, pace of enterprise AI adoption as well as tech spending outlook are amongst the key monitorables which we were looking towards. How does the scenario look like, and how are the pricing models evolving according to you?
So I'll start with that, maybe a little bit on the pricing. Jayesh might have some views. On the demand, we see a good demand outlook in the sense of we have had strong large deals. Our large deals pipeline remains healthy. And we are seeing in the two industries that I mentioned, on financial services, on an energy resources, utility services, a way that our work on AI is going, and the way the deals have shaped up, we see a good outlook as we look even beyond this financial year into the next financial year. On financial services specifically, we see discretionary spend and good traction in what we are seeing across the market. Having said that, overall, We want to still see all of the other industries and segments start to show that. But these two are definitely something that we are seeing today.
Yeah, and on the pricing, I think, as the newer and newer technology evolve, every time there is a change like that, you see a new pricing model evolving as well. We are seeing multiple new pricing model evolving. Some of them are being led by us, whether it is outcome-based pricing or whether it is, pricing which is specific to agents, etc. So little early in my mind in terms of calling out specifically what are the pricing models going to evolve on this, but everybody is testing new pricing models at this point in time.
Thank you. The next question is from Srishti Achar from The Economic Times.
Hi, Happy New Year to all of you. So, a couple of quick questions on one, I wanted to know in the sharp decline in operating margins that we're seeing. So, I want to know if the impact is beyond the labor code charges that the company has taken. And I also wanted to know in terms of, there has also been a sequential decline in your top contribution, revenue contribution from your top 5 and top 10 clients. So, why, can you give us a sense of why that is happening and what the next couple quarters look like on that? On the third, I also wanted to know sorry, this is the last one. So I also wanted to know in terms of, the whole H-1B row that is going on. So this morning also we saw some claims of, employees being deported on the same as well. So I wanted to just know what is going on around that.
Yeah, so if you look at the margins, if you're looking at reported margins, yes, the reported margins were impacted because of labor code. But if you look at the adjusted margins, as we have called it out also, the adjusted margins have actually expanded, if you exclude the impact of labor code. So adjusted margins have expanded by 20 basis points sequentially. And on a full year basis, it's remained 21%, which is similar to our last year margins. So, and that, as I said earlier, that was despite after absorbing the investment that we have done in sales and marketing, which would have impacted margins by 50 basis points, after absorbing the impact of lower utilization, which is building capacity for future. So after absorbing both of that, we've been able to maintain margins. You had a second question?
Client contribution.
Yeah, client contribution. I think sequentially client contribution is not a way to see in my mind, because there is a seasonality involved, right? Every Q3 you typically have furloughs, etc., which would have impact certain specific clients, and larger the clients, larger will be the impact of furloughs if there is one in that account. Typically you will see that year on year, and we don't really see a significant change in the year on year client metrics.
On your last question, I just want to read out, no Infosys employee has been apprehended by any US authority. A few months ago, one of our employees was denied entry into the US and was sent back to India.
Thank you. The next question is from Chandra Shrikant from Money Control.
Hi, Salil. Just to follow up to that. Employee who wasn't allowed and sent back, are you contesting that in any form? Secondly, one of the big trends this quarter we've seen is a big acquisition from Coforge, where they acquired Encora for $2.35 billion. TCS has acquired Coastal Cloud for $700 million. So can we expect more action on the M&A front? Are there, assets that are attractive? If you can take us through your M&A strategy. Thank you.
On M&A, so we have, as we've looked at over the last few quarters, we've done acquisitions on cyber, on consulting and energy services, and we will continue with that sort of an approach. We have a good pipeline of possible companies that we are looking at and discussions. We have strong support in terms of our balance sheet. So we will continue with that. It's not something that is different in that sense from what we were doing in the past. We have a set of areas. We're also looking sort of in geographies which are new. We're looking at expanding in some service areas where we can go deeper. So that will continue on.
On the IC, any other details that you can share?
That's what I had to share.
Okay.
Thank you.
Jayesh, sorry, just one thing on the labor code. So, according to your fact sheet, Infosys has incurred 1,289 crore on account of labor codes. So, has the full impact been absorbed, or will it sort of be staggered? How will that work?
So, whatever is to be accrued till this quarter end has been accrued in the books, right? Which is for labor code has impact across multiple aspects, whether it is gratuity, whether it is, other aspects of wage and that has been accrued. There will be an ongoing impact of roughly around 15 basis points that will happen on an annual basis. That is a regular impact of the labor code as we go ahead.
Thanks, Chandra. The next question is from Haripriya Suresh from Reuters News.
Good evening. A few questions. One on the H-1B front. Will you be looking at making new applications, or is it primarily just hiring in the US and the employees that you have already? In retail, is there specific softness because of how America is right now? And when do you sort of see that recovery? And third is, Salil, your term as CEO ends in March 2027, at least the 5-year term. What is succession plan? Has that started, and what is that looking like? Thank you.
On the first one, I think we on H1 and what the recruiting is. So our approach is very clear. We have, as we shared in the past, a majority of our employees in the US who are not requiring any visa situation. We are continuing with our deployments and our delivery using a mix of what we have work in the US and work in India. So no changes to that approach. At this stage, we are continuing with our process because there's an existing set. We will examine it as it comes up in the future. On retail, what we are seeing is there is some places where we see positives. There are some places where we see different client situations which are under some cost containment for that sub-vertical within that. So we are waiting and we are pushing to make sure that the retail pipeline, which is growing, becomes converted into what we drive into the retail growth. On my own situation, no comment.
Like overall, as a company looking at succession planning?
Yeah, no comment from my side.
Thank you, Haripriya. The next question is from Avik Das from the Business Standard.
Thank you. Quick questions. One, a little bit more on the BFSI commentary, because what we understand that financial services, BFSI overall has been improving in the North American geography. So which sectors or which subsegments within that sector is actually growing? If you can just throw some more light, Salil. And North America seems to have degrown on a constant currency basis. Any reason? Was it a client specific or was it any sector specific? Maybe retail that pulled it down. If you can just throw some more light. And Jayesh, there seems to be that idea that new large deals will be smaller or maybe far and few to come by as more AI-led deals sort of take the center stage. Keeping that in consideration, how do you think the margins are going to play out across the industry and for you in specific in the long run, if you can just throw? Thank you.
So I'll start off on financial services. We see a good traction across most of the sub-verticals we have within financial services. So we are seeing good traction with retail banks. We're seeing good traction with what are considered mid-market banks. We're seeing good traction on payments. We're seeing good traction in the mortgage area. So overall, pretty strong. Some are stronger, some are less strong, but overall we see a good demand environment. And there's good adoption of AI across the spectrum with our large financial services clients. We recently announced, for example, a partnership with Cognition, which is very strong, and we are working with them jointly in some of the financial services companies. On North America, nothing very specific. It's a mix of different industries and different plays. The overall situation on energy, utilities, on financial services remains strong. On some of our other verticals remains something that is coming back over time, but not yet. On the third, on the margin.
Yeah, on the large deals, if you look at the deals that we have signed $4.8 billion this quarter. If you look at even on a 9-month basis, compared to the last year, our large deal signings have gone up. So while there is always a productivity ask that goes up because of AI, etc., there is also a lot of deals that are getting structured because of cost optimization or cost takeout, etc., from the client side. So a lot is getting bundled when you look at it. And on the margin side, large deals always have slightly lower margin than the company average, but as a portfolio, you always make up on a margin because the new work that comes up at a better margin, etc. So that's a trend that we have seen. We have not seen a change in the trend from that perspective.
Thank you, Avik. The next question is from Sanjana from the Hindu Business Line.
Hi, good evening, gentlemen. So, manufacturing and Europe, they have grown significantly for Infosys this quarter. Both of these were previously seeing some softness. So, can you expand on what were some factors contributing to this growth? And also, I think the tech budgets for the calendar year 2026 are expected to be rolled out soon. Based on client conversations, what are you hearing? Is there any sign of uptick in discretionary spending? And also, the guidance was raised upwards despite seasonalities and uncertainties. Any reasons for this? And the last question. Regarding the collaboration with Cognition, which is an AI startup, what were the gaps in your AI portfolio that you were looking to bridge with this particular collaboration? How is this contributing to your whole AI, momentum? Just that. Thank you.
So starting on manufacturing in Europe, firstly, I think Europe's been in a good position for us for many quarters, and actually even manufacturing's had a strong activity across the board. We've seen good traction. There are pieces within the manufacturing client base, so which are benefiting massively from the AI growth. For example, we do work with companies that provide power solutions. We do work with companies that provide manufacturing into those solutions, that provide engine capacity, that provide generating capacity. So there's a lot of those pieces which are doing well, those client industry components which are doing well. And where our team is really active on that. We've also got some good traction within manufacturing on the engineering part of the work, engineering services part of the work. The second one...
Guided tech projects for 2020.
Tech budgets.
Discretionary spend.
On the discretionary spend overall, so first, on financial services, we are definitely seeing that what we shared earlier. We are seeing a good set of deals which have happened, and then we see that with the AI traction we have in that industry, we will become more, the next financial year will have better outcomes than this financial year on that. And financial services is going well this year. Similarly, on energy and utilities, we are seeing a good set of deals that have come together across the whole industry vertical, and that is helping us with that momentum. So those are the ones we are seeing. On the others, we are not seeing any deterioration, so which is one sign. And we see overall the macro environment seems to be where people are expecting maybe some interest rate cuts. So we'll see if that happens, especially in the US. And then some of the other expansions we are doing, for example, we have a program where we're working with some of our smaller sets of clients, and those are growing pretty well. So overall, we feel that as we look out into the next year, these are things that support our growth. Then on AI itself, we are seeing what I shared earlier, these 6 areas where we see potential good growth over the next several years, not just in the next year. And that will, as we start to execute on that, that will help us. On so which one was that?
Cognition.
Cognition, right? Yeah. On Cognition, so it's not so much a gap. So what the Cognition people are doing is they built an agent which is working to do software development. And we are working with our clients as a partner with them, where we are also building agent capacity, and we are enabling those agents to work in a client environment. So the advantage is we have a detailed understanding of how the client technology landscape is set up, and we have a good understanding of what are the industry constraints or opportunities.
First Indian news channel at the World Economic Forum at Davos. 21 years at the heart of the world's most influential dialogue.
Continuing
to make sure that the poorest are not forgotten.
Big enough, brave enough, bold enough to face the critics.
We've been doing more and more improvements.
We are the fastest growing amongst the major economies.
Both of us are interested in these.
Young girls aren't in school because they're scavenging for water for the family.
We need to get out of the way and into the work of breaking open access for each and everyone.
Now, India's most trusted news network returns to the Alps with its most formidable editorial voices. NDTV Ignite at Davos. This budget, India speaks from every direction. From metros to mandis, from factories to farms. NDTV Profit reports from 36 states and union territories. With our ear to the ground and our pulse to what people want. Watch Budget for Bharat only on NDTV Profit. What Bharat wants, what Bharat expects. We are listening before the Finance Minister speaks. Budget 2026, the growth agenda. Only on NDTV Profit, for your profit.
A very special moment for us as we announce NDTV Master Stroke, the NDTV Art Awards.
NDTV presents the Master Stroke Art Awards. An odyssey of creative brilliance where the masterpiece meets its ultimate recognition.
NDTV bringing this subject forward would have a great integrity of putting it forward where people could understand the importance of art.
This award that is being started, I'm sure is going to be amazing.
Art for India and for Indians is an expression of our Atmanirbharta.
It's actually quite a formidable jury, so I think we'll reveal a lot more as we go along.
This is an amazing platform, I think, today what you're doing.
Honoring the masters who define our creative landscape. Coming soon on the NDTV network.
Alright team, our new order show is ready. Now we need a promo. Something cool, something sharp.
Well, I'm sure we'll be having outstanding reviews, solid suggestions,
Expert advice. The latest trends. It's a lot simpler. We'll help people make the right auto decisions. It's got the cool stuff, geeky stuff, serious stuff, all of it, so that you can discover, decide and drive. I'm Siddharth Sharma and I am your Automate.
New year. New power panel. India Market Open. Now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock. With a table thumping buy.
And when the street wants the levels, he brings the chart.
Charts speak the truth, and I deliver the levels with no frills.
Parag Thakkar and Kush Bohra are now part of the morning crew with Tamanna, Neeraj and Alex. Same show, sharper voices. Every morning on India Market Open, your favorite market show just got better. On NDTV Profit, for your profit.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. It's been an incredible year, 12 months, for equity markets. Just not ours here in India. If you look at Brazil, or if you look at South Korea, you look at the USA, and the Nasdaq, despite quite a bit of chop and churn for that index and that market, they've all had amazing returns. And so some of you might be thinking, when will it be India's turn? And should I be looking at 2025 as a bit of a lost year? How should you align your strategy heading into the new year? Vijay Mantri is joining me today, investment expert and someone I enjoy speaking with for these sort of conversations in particular. Vijay, thanks so much for taking the time. In fact, I must say that the springboard of this conversation was a social media post that you did, highlighting this very point. But you were saying that the devil is in the details. It might actually look really pretty on the surface, but what is contributing to this is interesting to note, isn't it?
Yes, that's very true. That's very true.
So why don't you tell us about it?
So you rightly mentioned that the Korea just knocked off the market 73% return. Then you have a Brazil more than 30%, Taiwan 28, 29, China 28%, and US 18%. But a lot of people has been advising to take money out from India or perhaps diversify into international market. And one of the reasons was that Indian markets were overvalued market. The valuation was crazy. But if you look at data, then you'll figure out that if you look at, for instance, US market, more than 50% of the return has come from 7 stocks only. And within the 7 stocks, Google delivers 66% return, but Apple and Amazon has been 5-6% return only. If you look at Chinese market, more than 50% return came from 6 stocks. If you look at Korean market, more than 50% return came only from 2 stocks. And if you look at Taiwanese market, then more than 50% return came only from the single stock. And if you look at the market of Taiwan, South Korea, and China, and USA, most of these stocks which deliver these returns are the stocks which have anything to do with AI, whether it is AI investment, whether AI-linked companies or semiconductor companies. So what you are doing is basically you are taking money from India, which is 23, 24 P multiple, and perhaps investing in the market, which is, or a stock which are 35, 36 P multiple. Second thing to keep in mind, if you look at even China, non-AI, non-tech stock is actually negative territory. So it is very important when you look at data, just go beyond surface level. There's a one part. And the second part, if you look at Korean market, and even for instead you look at European market, deliver more than 30% return. They have underperformed for last 10, 15, perhaps 20 years. So what are the point where you should, tipping point where you should be start investing in these markets 5 years before, 10 years before, 3 years before? It just happened that in 2025 that delivered these kind of investment performance. So these are the kind of thing. But India, in my opinion, is structurally a consistent compound story. And Alex, if you remember, we spoke in your program about a small and mid cap at least few times, and we also spoke that 2025 is going to be year of accumulation. And Alex, as you know, the market have 3 phases. One is a boom phase, one is a drawdown phase, and third is accumulation phase. We are not going to see big drawdown phase in India. And we can discuss why we don't see big drawdown phase in India. It is just an accumulation phase. And whenever you accumulate, the longer you accumulate, the gain comes very sharply. And we can go to history and I can explain why this happened in Indian market and why it will happen in future as well.
Yeah, in fact, in conversations that you've had with me, you've identified portions and you've given examples of portions where a particular scheme has gone through a period of trouble where your NAVs or your per unit cost has actually fallen or price has fallen quite dramatically, and those that kept their SIPs going were able to accumulate much more units at a lower cost. Ultimately, that accumulation phase is exactly that. But I want to try and draw a parallel, Vijay, if you can, with the Indian equity markets in the past as well, because you look at data so closely. Would you be able to liken this to what the equity markets experienced during that Ritik phase, where there were only a few stocks that were leading to these outsized gains and a large part of the market was actually languishing, not doing too well, right?
Yes, that's very true. And that is a reason that most direct investors don't end up making money, because in year 2020, if you're listening to people, they will say that invest in Ritik stock, because in 2020, out of total profit pool of listed companies, more than 10% belong to FMCG companies. Now that has come down below 4%. It's a dramatic fall if FMCG companies, all the Ritik stock has challenging period. And even if you look at 2025, you just look at Nifty 50, Nifty 50 actually index hides stock level pain. Who made money for you in 2025 Nifty? It's very interesting to look at the number. Shriram Finance, Hindalco, BEL is the kind of company which made money for you in 2025. Where you lost money, entire IT pack, TCS, HCL, Wipro, Infosys, HUL, pharmaceutical companies, TVS Motor, all the past darling of the market lost money. So this is a trend we are seeing because the profit pool keeps changing and the way the underlying Indian economy keeps changing. So there's a one part one need to keep in mind when you look at data. The second part is that if you look at Nifty 50 2025, out of 50 stock, 32 stock deliver positive return. And out of 50 stock, 26 stock deliver more than 10% return. So in India, what you get is more diversified, more, it is not concentrated in one sector of the economy. On the contrary, it is much more diversified pool which India offers you. And that's why I believe India is a more of a structural and more of a continuous compounder kind of a story than a opportunistic play like China or some part of Europe.
Yeah. So let's talk about strategy heading into the 2026. And we've seen just a couple of weeks go by, right, Vijay? The tendency of a lot of investors would be to chase returns. And so from that perspective, you would see a lot of people gravitating towards your overseas funds. They might even use GIFT, or they might use their LRS route in order to put money into some of these schemes. And you've said why that might not be the best idea. What should be the strategy in your opinion, and why?
So this is the proven fact that not only in India but everywhere in the world, people chase historical return, and particularly last 1 or 3 years return. So for instance, if you look at the best perform asset category this year, gold, silver, or Europe, and Korea or Brazil, but just look at 2025 in the beginning of 2025 or 2024, who were talking about Brazil, South Korea, Taiwan, China. Very few people were talking about, and everybody was talking about US market and perhaps continue to stay invested in Indian market. So in my opinion, current market condition, what one need to do is to look at where is the GDP expansion happening. Ultimately, when GDP expansion happen, sometime with a lag of 1 or 2 years, we see corporate earning catching up. And I'll give some historical perspective to you. Between 2000 to 2003-4, for a 4-year period, the the EPS expansion happened just 7% per annum, where GDP was growing at 12 to 13%. So that was a great accumulation phase, 2001, 2002, 2003. If you accumulated unit during that period, then 2004 to 2007, we have seen amazing bull market. We have some similar data from 2013 to 2017, where EPS expansion happened at just 2% CAGR for a 3 to 4 year. Now we're witnessing the similar kind of thing. If you look at 2024 and 25 and 26, the EPS growth has been very, very low. And this perhaps is one of the best accumulation phase, because ultimately the corporate earning will catch up with GDP expansion. It may lag more 1 or 2 or 3 years. But if you're a long-term investor, if you're an SIP investor, this is the phase where you should welcome much more, though it looks very difficult to digest when you are going through that process. But when you wait and then see after 1 or 2 or 3 years, the kind of return you get, it only happens when you go to drawdown phase. So in any asset category, the best return accrues to a person who's able to withstand the drawdown or accumulation phase. And right now we are not in drawdown phase.
Okay, so therefore, bottom line is you double down on India right now, particularly because it will eventually play catch up, or there will be a move in the earnings and thereby the returns will follow. And I'm guessing, Vijay, that you're saying there won't be a drawdown because there is plenty of liquidity in the market, a lot of money flowing into mutual funds, and there is a base that forms also. And there may be other factors. But having said that, would you say you can venture into the small cap space, particularly because if there is one pocket that has seen a little bit of pain, it is that, right? You look at mutual fund performances also over the last 12 months. So would you say that now is the time to double down on those investments?
So the first, let me answer this liquidity question. We have been discussing, people keep talking about this very often, that SIP number 30,000 crore and all.
Sure.
Sort of thing we keep throwing out. So total money which mutual fund got in last couple of years is on average 3 lakh crore rupees, okay? We Indian buy gold worth 8 lakh crore every year. And if you look at real estate deals happening in MMR region alone, every quarter we have seen 50,000 crore of deal happening only in one quarter. So this number is nothing. And SIP is just one of the things. You have a AIF, you have a PMS, you have a NPS, you have a EPFO money, you have a private equity money. So lots of things are happening. Now, the question of where one should look at in this market, so in my opinion, there are many interesting opportunities available. However, mid and small cap is not yet the place where one look at investing. Even if you want to invest in mid and a small cap, please do only through SIP route and don't expect magical thing to happen. We have seen, and one of the more reasons that market we not see big drawdown, because we haven't seen big numbers. So we discussed this in past. I'll just give you two historical points for us to understand. In 1992, when the market fell 50%, but before 1992, 10 years Sensex return was 21 times. If you look at 2008, again the market fell more than 50%. But from 98 to 2008, the average growth in the NAV of mutual fund was 21 times. When we looked at data for 2024 September, the highest growth has happened in a small and mid cap, where the NAV is grown 7 to 8 times, and that was a little bubble. But Nifty level, if you look across all the indices, if suppose you see, the return vary from single digit in pharma to around 13-14% for the most of the indices. So that is the reason that when you don't have 20%, 30% CAGR, the drawdowns are very limited. So in my opinion, even that phase is gone. Mid and small cap is not the place to be in. Even if you want to be in, do SIP, STP, but wait for a little longer time. In the current market, I think one need to look at multi-asset fund, one need to look at balance advantage fund, one need to look at credit opportunities in private credit. One can also look at managed real estate portfolio where rental yields are fantastic. One could also look at, definitely one need to look at flexi cap and large cap, and couple of themes we can discuss where investor can look at investing.
Yeah, and what we're going to do is, Vijay, we'll hold that for maybe next week, the themes conversation, because I want to have a more detailed conversation on some of these themes that you like. But I think we've given our viewers enough food for thought about their investment strategy heading into the rest of the year. Thanks so much for joining me as always.
Pleasure.
All right, now some of you might be uncomfortable with the idea of parking money in mutual funds, and that's perfectly fine. You would generally gravitate towards fixed deposits. But the question that I'm asking today is, should you go for savings bank accounts, and these are your regular accounts, in banks that are offering you significantly higher than your large frontline banks like ICICI or HDFC Bank or SBI even? In fact, I was looking at a list, a colleague helped me compile it, and you have someone like an IDFC First Bank, which on deposits of 10 lakh to 20 lakh in your savings bank account, which admittedly is a large amount, gives you 6.5%, which is a pretty substantial amount. So let's ask what your strategy should be in a low interest rate environment as we're experiencing right now. We're joined by Dilshad Bilimoria, who's Managing Director and Chief Financial Planner of Dilshad Consultants Private Limited. Dilshad, thanks so much for taking the time. And let me ask you this. What is your opinion on these high interest rate bearing savings bank accounts in these smaller private sector banks and small finance banks?
Yeah, so definitely I think one needs to look at the credibility, the asset liability ratios and the liquidity of these banks. Sometimes what is out of the ordinary could be a dangerous situation as well. So especially if it's cooperative banks, etc., I think those are things that one needs to consider in terms of what is the promoter background, and because we've had in the past, right, instances where misuse of funds or misappropriation of funds or usage of funds for loans, etc. So as long as you have the ratios of the bank balance sheet, I think that is an indication for you to take a step in that direction and invest in such options. Yeah.
But Dilshad, from the perspective of the average Indian, right, they're not going to go into balance sheets and all of that. So from that perspective, you're looking at banks that are pretty well known. I'm talking about IDFC First Bank, RBL Bank, DCB Bank, Bandhan Bank, IndusInd Bank. These are listed entities, and even in the small finance bank space, you're talking about Equitas, you're talking about Suryodaya, or you're talking about Ujjivan or Utkarsh. They're relatively well known from that perspective, right? We're not talking about your regional rural banks or commercial or scheduled commercial banks or thereabouts, right? So what should the approach be here if you were to, for example, park your emergency fund here rather than a liquid fund?
Yeah. So I would suggest, Alex, between 6 to 12 months, of your emergency monies can be, locked in here. Definitely these banks are giving these benefits. But they come with certain caveats, right? So some of the banks like IDFC and Equitas, etc., they say that you need to keep a minimum balance of above 50 lakhs or a crore at any point in time. Further, you cannot make withdrawals beyond a certain frequency at certain intervals. So like I said, it also depends on the bank's borrowing, lending and their liquidity requirements. So as long as the minimum restrictions and the caveats are, kept in bay, I think that should be fine. And further, it's important for every investor to understand that the credit bank guarantee scheme offers up to only 5 lakhs as, in case there is a kind of a fraud and we've seen this in the past, right? So it's just important that investors just don't blindly go with higher interest rates because they're being offered. I think due diligence also has to be taken and generally when the interest rate scenario today in the industry is declining, there have been 5 rate cuts that have happened. So I think these are factors that investors need to look at before deciding on what is the bank offering.
Sure.
It cannot be figured just like that.
So that is exactly why I'm asking, Dilshad. Would you therefore, rather than parking money in a fixed deposit, which you might have to lock for 3 years or 5 years, considering that we're close to, if not at the bottom of the interest rate cycle, park money here instead? That was the question.
Yeah. So you definitely can look at that. In fact, there are these quasi FD schemes also, which actually might give you better rates than normal savings bank because that works better for the liquidity requirements of the bank. So how it works is that, say your normal savings bank account holds a certain amount. You can say anything above that a limit, and you can set a limit of 5 lakhs, 10 lakhs as you deem fit, and tell that you would want that extra money to go into a sweep-in option, which gives you a higher rate as high as 8%, depending on which bank that you're choosing, 8 to 9%, and then sweep it back. So, of course, now some savings banks are even offering between 6 to 8% on their savings rates. So as long as the bank is kind of, well established and fundamentally strong, etc., I think it should not be a problem to park between 6 to 12 months of one's liquid needs in that.
Okay, so bear in mind that what Dilshad is speaking about is the sweep-in facility that is offered by several banks. So in case you want details of that, you should contact your bank to do this. Now, from an operational standpoint, and this is just hypotheticals, of course, Dilshad, that I'm asking you about, but it bears in mind that you have to speak about this at some point. You have to plan for it. It was actually pointed out by one of our viewers itself, who said that he keeps a large amount of money in his bank account and has his partner have access to it because he himself had a situation where he was not able to access funds and he had a medical emergency. So is that a good reason to have a decent amount of money lying in your savings bank account?
So again, this comes back to the point of maintaining the emergency reserve. And today, Alex, there are so many options to take care of, emergency or liquidity requirements. Even your credit card is accessible immediately. Yes, it's important that you give the access credentials to your partner as well, because in emergencies when the main person is not able to kind of take action or decisions on certain immediate liquidity requirements, yes, you need to have somebody who has access to this. So like I said, it falls under the emergency net that one can keep in the bank.
Okay. Now, I began by talking about looking at savings bank accounts and fixed income investments outside of mutual funds. But would you say that in this current scenario where we have interest rates where they are, that this is actually an opportune time to look at arbitrage funds, particularly if you have an outlook of more than 6 months and if you intend to hold for more than 1 year indefinitely, because then long-term capital gains tax equity comes into play as well. So tax-wise as well as opportunity cost-wise, it's a better instrument to consider?
Most definitely. So like you rightly said, anything between 1 month to 1 year, an arbitrage would be the best kind of investment option, considering, and it's safe as well, right? So it has the safety of a debt fund or a fixed income, and it has the taxation of equity, which makes it a very interesting proposition, provided the time horizon is maintained. There are newer interesting investment options like the SIF, etc., but those have to be looked at both from the risk profile and the time horizon of at least 18 to 30 months as the investor requirements. And mind you, these are also suitable for between balanced and conservative risk profiles, provided the investor is clearly aware of the various strategies that the fund manager is using.
Fantastic. Actually, that explains it very well. Dilsha, thanks so much for taking the time, and pleasure speaking with you as always, and wish you all the best in 2026.
Thank you, likewise. Thank
all right.
you.
Well, we've kind of tried to give you perspective. Just because a financial institution is offering you a great rate of interest doesn't mean you need to rush after it. So make sure that it fits within your overarching framework of risk and reward. That brings us to the end of this edition of Your Money Matters. Thanks so much for tuning in. This is NDTV Profit.
The first Indian news channel at the World Economic Forum at Davos. 21 years at the heart of the world's most influential dialogue.
Continuing to make sure that the poorest are not forgotten.
Big enough, brave enough, bold enough to face the critics.
We've been doing more and more improvements.
We are the fastest growing amongst the major economies. Both of us are interested in these.
Young girls aren't in school because they're scavenging for water for the family.
We need to get out of the way and into the work of breaking open access for each and everyone.
Now, India's most trusted news network returns to the Alps with its most formidable editorial voices. NDTV Ignite at Davos.
Well, we are on this budget yatra, and we are in the midst of a solar field, and we are at the KP Group's facility in Sudi in Gujarat.
At the Biswa Bangla Gate, New Kolkata meets old industry. From Century Ply to Titagarh and Berger Paints, The message ahead of the budget is clear. Growth needs clear policy support.
NDTV Profit is in Indore, India's cleanest city. But in store, we are going to look after Indore's nightlife, what are the industries, and of course, the industry's budget expectations.
NDTV Profit has travelled all the way to Lucknow. This city is known for its delicious Awadhi food. This city is known for its tehzeeb. And this city is known to be one of the top 5 GDP contributors to India's development.
Budget for Bharat travels to the city of Bengaluru, a city which has given us so many innovators, so many startups. I am spending time in a startup hub to get a pulse of the city and to find out what the startup founders want from the finance minister.
Coimbatore, a pretty big city in Tamil Nadu, known for industry, known for its textiles and also filter coffee. It's been called the Manchester of South India for a reason, and that's because of spinning and because of textiles. I've got Saurabh Mukherjee as well as Nandita, who is the economist at Marcellus, and we're actually going to be going to a few places over the course of the day.
A very special moment for us as we announce NDTV Master Stroke, the NDTV Art Awards.
NDTV presents the Master Stroke Art Awards, an odyssey of creative brilliance where the masterpiece meets its ultimate recognition.
NDTV bringing this subject forward would have a great integrity of putting it forward where people could understand the importance of art.
This award that is being started, I'm sure is going to be amazing.
Art for India and for Indians is an expression of our Atmanirbharta.
It's actually quite a formidable jury, so I think we'll reveal a lot more as we go along.
This is an amazing platform, I think, today what you're doing.
Honoring the masters who define our creative landscape. Coming soon on the NDTV network.
Alright team, our new order show is ready. Now we need a promo. Something cool, something sharp.
Well, I'm sure we'll be having outstanding reviews, solid suggestions,
Expert advice, the latest trends. It's a lot simpler. We'll help people make the right auto decisions. It's got the cool stuff, geeky stuff, serious stuff, all of it, so that you can discover, decide and drive. I'm Siddharth Sharma and I am your Automate.
New year, new power panel, India market open, now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock. With a table-thumping buy.
And when the street wants the levels, he brings the chart.
Charts speak the truth, and I deliver the levels with no frills.
Parag Thakkar and Kush Bohra are now part of the morning crew with Tamanna, Neeraj and Alex. Same show, sharper voices. Every morning on India Market Open, your favorite market show. Just
Very interesting conversation coming up with Pankaj Tibrewal, founder and CIO of Ikigai Asset Manager. Pankaj, thank you so much for speaking with us. I was just going through your post, which has gone viral. I wonder if we can get it up on screen, where you've talked about what all 100 baggers have in common. And while we get those graphics up, I'm going to start with point number 1. They start small in very big markets, small fish in a large pond, and you've given the example of Bajaj Finance. Are you seeing any such 100 baggers right now?
Thank you. Thank you for having me on the show. See, the idea of writing this post was that today the sentiment is extremely fragile. There's a lot of news flows, headlines, geopolitical issues, but that should not take away our focus that over a period of time in the last 25 years, we have seen much worse of the news and much worse of events play out. Still, we have seen market creating a lot of multi-baggers over a period of time, and hence bottom-up approach should be not forgotten during these times. The first point which you mentioned was small fish in a large pond. Is that the runway for growth for any of these companies which became 100x over a 20-25 year period was that the tailwind of the sector was always there in terms of growth and runway for growth. And hence we gave this example, which is apt for India, that when Bajaj Finance in 2008-9, if you go back, they were just 0.2, 0.3% of the total credit market in India. And hence you had a long runway for growth. Still after compounding so fast, they are still at just 2.3% of the market share in terms of total credit market in India. So the idea was that whenever you look at any company, if it is a small TAM, then they will be fighting to gain market share in that small TAM. But if it's the opportunity is very large enough, then they will get opportunity to grow without fighting, and then they can look inwards and try and see how they can take market share away from a medium to long-term perspective. So that's the first point, which we have seen common in all the multi-baggers in India or global, that the TAM was quite large, the opportunity size was very large, and slowly and gradually these companies compounded and took away market share in the large TAM. So that was one. As your point, can we see it today? Answer will be on the hindsight, definitely yes. The best part was that all these multi-baggers, you never saw it the 100x coming in. As they kept on executing, I think you knew that they are on the right path. If I say that today I know for sure which are 100x, I would be lying. Because nobody knows at the start which is going to become 100x. You just gradually observe them over a medium to long term, and that's how the multi-baggers kind of create. And the power of compounding is so huge. I mentioned it, that 20% growth in any year doesn't look that exciting. But if it is done over a 25-year period, it becomes 100x. So that's the power of compounding over longer periods of time.
No. So, Pankaj, to rephrase, I don't expect anyone to know today what is going to be 100x. If they did, and if they claim they do, they probably are not telling the truth. What I meant to say is that, things are looking a little bleak right now. And then the worry is, are we in an overvalued space? Are we tapped out? Is there enough discoverability there? So, okay, let me minimize those expectations. Not 100x, but future winners. Do you think there are enough and more right now in the Indian market which are still undiscovered?
Absolutely. I believe that from different sectors it would come. You look at the non-lending piece in the last 5 years with the market growth coming in. The non-lending capital market piece has done so well, whether it be exchanges, depository, AMCs, all have had their own share of growth over the last 5 years. And I think this is one segment one should be keeping an eye on, apart from lending. Then the second space is the entire consumption basket, where you are seeing the discretionary spends taking over the staples. And we believe that wherever there is aspiration at the right value, that segment will create huge value as you move ahead on the per capita GDP side. The third segment is chemicals. We are a tiny part in the global chemical industry, which is almost $1 trillion plus industry. And slowly and gradually, China is vacating the lower end of manufacturing. And India has that chemistry and skill sets to go up the value add ladder. So I think chemicals is another. Look at the auto ancillary and the precision engineering part. I think it's a very large opportunity in terms of defense, aerospace, semiconductor part that will create huge values and winners over a period of time. So it will come from cross-section of industries. In AI, for example, you will need companies in the mid-tier and the lower tier to implement it. So you will see over the next 5-10 years winners emerging from the IT space. And this is a very interesting space that every decade has created new winners. So last decade, you saw Coforge, Persistent, and all those winners getting created at the expense of large caps. So probably next 5-10 years, you will see more such new names getting emerged, or maybe the mid-tier names getting into large cap names over a period of time. So I'm very, very positive on a bottom-up opportunity in India. And slowly, as you go down the market cap curve, the analyst coverage on those stocks starts to drop. And that's where you can do a lot of scuttlebutt, add value, in terms of what can happen over a period. And once market caps becomes larger, the analyst community starts to cover. So there is a discovery phase which can happen between 5,000 crore market cap to 25,000 crore market cap. And I think that's a very sweet spot many companies are sitting on right now in India.
Very interesting. Pankaj, we have some corporate conversations coming up, so I may not have as much time as I usually would like with you, but I'm tempted to ask you this one question. I saw your newsletter and a few days ago, and in that newsletter, you've mentioned that silently there is this capex happening both on the private side and the corporate side. Most sell-side notes that we see lament the fact that capex is not happening and they're not constructive on capex plays. Your note seems to imply that you are not in the same camp. So are we to understand that you are constructive capex beneficiaries for 2026, or am I reading it wrong?
So Neeraj, you are absolutely right. When you look at the data points compared to the narratives which is currently prevailing, is that private capex is on a hold, it's slow. But the data suggests otherwise. The trailing 12-month private sector capex, private and government sector capex is at about 11.5 lakh crores. Don't forget, this number a few years back used to be in the range of 5 to 6 lakh crores. So slowly and gradually we have inched up to 11.5 lakh. And when you combine it with the state and the government capex, the number is at 31 lakh crore plus. So the point which we were trying to say is that capex has started at the margin, and it's not as bad as what people are making out to be. The only thing we need to be worried about is that the capex today is very loop-sided, done by few groups. And hence, you need a broader breadth of companies and sectors to start participating in it. And once that starts happening, I think the private sector capex should be the next driver of growth in India. And hence, we wanted to bring that point that all is not lost. What people are saying is that capex is extremely slow, is not absolutely 100% true. The trailing 12 months suggest that we have inched up to 11.5 lakh crores on private sector capex.
Wow. Okay. So that is one. The other, Pankaj, is this whole set of pockets which have come under I don't know whether it's temporary or permanent, but I'm calling it temporary. A temporary cloud, which is this whole energy transition space or the power sector, right? The darling of better part of 2024 and better part of 2025 as well. The last 6-7 months, be it wind energy, be it thermal, be it ancillaries, all of them have lost ground, lost valuation multiples. Now, do you foresee, because the government intent is there, that there will be a prolonged capex and growth cycle for these names, and at some point of time, they might rediscover the mojo because of cash flows, because of subsidies, because of this whole energy transition bucket? And are you constructive power and ancillaries?
So Neeraj, I think we had extended this narrative and theme too far in my view, in terms of the valuation which we were ascribing to most of the companies in this sector. I think market is mean reverting those valuations, and hence we are seeing the pain. You had companies trading at 100p, 150p, which probably was not correct in my view. Still, after correction, the valuations which are there on the headline basis seems to be on the higher side. I'm not disputing that the energy transition is real. World is going through that. And now we have more power coming from wind and solar than coal across the world now, right? Electricity. So I think that is a real thing which is happening. But in India, don't forget that a large part of the value chain and the ecosystem, we have been just dependent on import. We don't have a fab unit. We don't have a big, large ecosystem for cell manufacturing. A large part of capacities and stocks which were coming in were from the module manufacturers, which is nothing but more of an assembly job. And market was very charitable in giving very high valuations to them. I believe that this probably will take some time and unwinding itself. In the power overall, we are positive. I think India has seen lower power growth last year, and that weighed on most of the power utilities as we speak. I think that has started to change. Probably this will change this year. December was the first month where we saw 6% power demand growth. And if that starts to happen, a lot of utilities on the private and public sector, plus the transmission part, I think is looking very attractive post the correction. So we are very selective in our thought on the power sector, but from a medium-term perspective, we are positive. Also, we don't forget that a lot of pump companies, a lot of these solar module companies didn't generate cash flows. The operating cash flow for 5 years in a row have been negative. And people justify that growth is coming, so cash flows are not important. But don't forget, growth without cash flows can be toxic and can destroy value.
Pankaj, we're looking forward to an important period right now, and the budget, among other things, would be the next driver for markets as well. I know this is a government that looks at reform outside the budget as well, but what are you hoping to hear and see from an India perspective, from an economy perspective, from the budget?
So I think nothing wrong done on taxes, I think will be a good news for overall markets. I think one thing which government needs to really think about is the buyback tax. Today, buyback has become virtually non-existent. We believe that there's a large amount of capital which is stuck, which is not either going for capex or not getting returned back to the shareholders. It's sitting in, funds, small liquid funds or bank deposits or whatever. And that multiplier impact is not getting created. So I think buyback tax, which the companies use to distribute the excess cash, I think should be reviewed. It's a large amount. If you look at all the IT companies and cash-rich companies, either they can deploy that back into their business at or the capex, or they can distribute. I think that is not happening. That one thing one should be looking forward, and something to spur the momentum back into the private sector in terms of capex side. I think these are the two important drivers. Government did a lot last year in terms of consumption. You saw the tax rate cuts in the last budget, followed by GST rate cuts. So I think government has trying to revive that consumption basket alongside, I think, manufacturing, because don't forget that the government capex will not rise at the same pace which we saw in the 4 years post-COVID at 33% CAGR. I think last year we saw it's just increasing by 8-10%, and probably that will be the path going forward in the next 2 years. So I think private sector needs to be really pulled up in terms of capex visibility for the next few years for the economy to sustain the growth momentum. So these are the few things I would look forward for.
But Pankaj, how will that really happen? I mean, in terms of government spends, at least, the space has shrunk after what they did with income tax and then with GST.
Yes, so I think there are 2-3 avenues. I think a large part of disinvestment is one thing which we have missed for the last 5 years in a row. Every year we come up with a number. This year was a smaller number, but still we are running or trailing behind that number. So that is one area where we can get substantial amount of revenues in terms of disinvestment. The second part is the RBI dividend. I think that number could be a decent number this year as well. And the third part is that once the nominal GDP growth starts to inch up, the top line growth of corporate India also inches up, which means higher and better tax collection. So India needs some kind of inflation, which probably we have not seen for a long time at the producer level. I think with commodity prices going up, that should also be okay. But this year, as a house, we are looking at about 2 to 2.5 lakh crores of revenue shortfall, which should be bridged by higher dividends, maybe some tinkering on excise duty from the OMC side, and disinvestment if it can be hurried up for the next 2 months, and higher dividend from RBI. So that's the shortfall bridge which is there right now, about 2.5 lakh crores, which can be bridged by the government in the near term. But from a medium term perspective, I think finally it's growth which has to lead to higher tax collections.
Okay. Pankaj, one last question very quickly, and which is if the money is rotating out of developed markets and US markets into emerging markets and India has underperformed, could 2026 be the year of outperformance? And are there themes to play that? 60 seconds odd, Pankaj, if you can.
I think, Neeraj, my belief is that India can surprise this year. Everybody is negative. And I always believe market is a Triveni Sangam of three things: fundamental, flows, and sentiment. Today, fundamentals, incremental basis on the macro side has been much, much better than what we were at the start of the last year. So I am quite hopeful, and earnings growth picking up in terms of FY27 being double digit compared to FY26. I think that's a fundamental, incremental, better change. Sentiment is crushed today. You speak to anybody, everybody is negative. I think it's a contrarian signal. And probably, in my view, if turn of events happens with a trade deal with US or something settlement on the geopolitics, I think that sentiment can turn around faster. Flows, we have seen the worst in terms of $19 billion being outflow. I think this year, if AI trade gets some picked out, I think, and I'm a little negative on the AI trade globally, I think India can find flows back into it. And FDI, which has been net FDI, which was very bad last year, $80 billion of gross FDI, less than $1 billion of net FDI. I think incrementally that would also change, supporting rupee and balance of payment. So incrementally, I think fundamental on our side, domestic flows is okay. FIs can revert back. And third, sentiment, I think, is crushed down today. Incrementally, if that changes, I think the Triveni Sangam starts to make a lot of sense. And in that way, India should outperform the other emerging markets. That's our hope. Let's see.
Cross fingers for that. Pankaj, thank you so much for joining and giving us that perspective. And lovely talking to Pankaj Tibrewal.
The first India news channel at the World Economic Forum at Davos. 21 years at the heart of the world's most influential dialogue.
Continuing to make sure that the poorest are not forgotten.
Big enough, brave enough, bold enough to face the critics.
We've been doing more and more improvements.
We are the fastest growing amongst the major economies.
Both of us are interested in these.
Young girls aren't in school because they're scavenging for water for the family.
We need to get out of the way and into the work of breaking open access for each and everyone.
Now, India's most trusted news network returns to the Alps with its most formidable editorial voices. NDTV Ignite at Davos. This budget, India speaks from every direction. From metros to mandis, from factories to farms. NDTV Profit reports from 36 states and union territories. With our ear to the ground and our pulse to what people want. Watch Budget for Bharat only on NDTV Profit. What Bharat wants, what Bharat expects. We are listening before the Finance Minister speaks. Budget 2026, the growth agenda. Only on NDTV Profit, for your profit.
A very special moment for us as we announce NDTV Master Stroke, the NDTV Art Awards.
NDTV presents the Master Stroke Art Awards. An odyssey of creative brilliance where the masterpiece meets its ultimate recognition.
NDTV bringing this subject forward would have a great integrity of putting it forward where people could understand the importance of art.
This award that is being started, I'm sure is going to be amazing.
Art for India and for Indians is an expression of our Atmanirbharta.
It's actually quite a formidable jury, so I think we'll reveal a lot more as we go along.
This is an amazing platform, I think, today what you're doing.
Honoring the masters who define our creative landscape. Coming soon on the NDTV network.
Alright team, our new order show is ready. Now we need a promo. Something cool, something sharp.
Well, I'm sure we'll be having outstanding reviews, solid suggestions.
Malana Sasalu, who is the CEO of South Region for Puravankara, is right here to take us through what's really aiding the stock movement and what is it that the market is really liking about their business update. So very good to have you on NDTV Profit, Malana. I want to first understand the key aspect because of which the market is really positive is the average selling price improved by 12% on a year-on-year basis, and of course your volumes, GDV, have also shown very good additions. So what are the key highlights of the business update that you're giving for this particular quarter?
Thank you very much for having me here, Nisha. As you rightly put it out, our sales have improved, and compared to the same quarter of the last year, we have gone up by around 17% to 1,414 crore rupees, which we have done well. And our collections has shown improvement quarter over quarter, where we have reached around 1,140 crore rupees of collection, and so that's fantastic. And also that in our burn rate has gone up. That is the construction. We have spent around 8% more in every quarter, so that's also reflecting in our collections. So overall, it's been a fantastic quarter, even though that I wish we had another couple of launches coming over, but we had one launch, and it has received a reasonably good response from the customers. So overall, it's been a very good quarter in every which way we look at it. And most importantly, that this has paved way for the next quarter, wherein the approvals have further progressed in terms of the movement within the ranks of the government offices. And I'm pretty sure that the next quarter that we will have more launches coming into the fore, as we had projected in the beginning of the year, that we're going to have 7 launches or 8 launches in Bangalore and 1 in Coimbatore and 1 in Cochin, and they are all in order. So most of them we should be able to launch within this quarter, or some of them may slip to the next quarter, but nevertheless, it is all in good shape.
Right. So, Malana, you are quite an outlier in the sector today with the stock performing so well, but real estate as a sector and the real estate index is one of the key draggers in the overall market, which is still buoyant. Now, I wanted to understand when you clock in these kind of sales and your future projection with the new launches is also looking very positive. What are the factors which really aided to the sales volume growth as well as better pricing in this particular quarter?
Just the fundamentals of the business, following the fundamentals of the business, that is that operationally that we have become very efficient, and the teams have come together in terms of your sales, marketing, and the engineering, design. And if you see that all disciplines of the business is working well, and that's been our key for transformation in maybe this year, the entire year, what you're seeing, and so that is what is aiding. And also about the launch that we have had is a good launch that we had. And the products, that some of the things that the improvement in our sale price or the per square feet realization is also due to selling some high cost inventory in the market, and particularly in Chennai, one of the projects has done extremely well. In Bangalore, Deansgate has done extremely well. Somerset in Chennai, which is a high price inventory. So that's the reason we have done well. And as we have been telling since the beginning of the year, that we've got number of launches that are coming in. Yes, there's a supply side. There were some problems relating to e-khata, this and that. In the long run, they're all very good for the industry. And now I think we are coming close to it, and probably market is looking at us, and the market is observing us. I'm very happy about that they're observing us.
Right. In your outlook also, Malana, that company has said that the residential demand has softened in the third quarter, and also the volume declined 16% YOY in Q3. What is the reason? And also in the coming quarter, how are you seeing the residential demand?
I believe that the numbers are to be seen a little differently in my opinion. That I think there is a little bit of slowdown in the supply side of the goods, and that's the issue why you see that reduction in the sales volume. Yeah, maybe 3-4% might have been because of the demand in the market, but the rest I think 11 to 12% is also there's a new product coming into the market has slowed down. When do we sell a lot? When we actually bring the new product to the market, and during the launches that we have good set of sales that happens, and that has not happened, and particularly in Bangalore that we've not been able to bring product to the market. So I don't see this as any deterrent for us, and I see that the markets are doing extremely well in my opinion wherever that we are launching the project, and there is good walk-ins and good sales are happening.
All right. So all the best for the quarterly performance. Thank you so much for joining us right here on NDTV Profit. Puravankara stock really star attraction of the day with the business update.
First Indian news channel at the World Economic Forum at Davos. 21 years at the heart of the world's most influential dialogue.
Continuing to make sure that the poorest are not forgotten.
Big enough, brave enough, bold enough to face the critics.
We've been doing more and more improvements.
We are the fastest growing amongst the major economies.
Both of us are interested in these.
Young girls aren't in school because they're scavenging for water for the family.
We need to get out of the way and into the work of breaking open access for each and everyone.
Now, India's most trusted news network returns to the Alps with its most formidable editorial voices. NDTV Ignite at Davos.
Well, we are on this budget yatra, and we are in the midst of a solar field, and we are at the KP Group's facility in Sudi in Gujarat.
At the Biswa Bangla Gate, New Kolkata meets Old Industry. From Century Ply to Titagarh and Berger Paints, the message ahead of the budget is clear. Growth needs clear policy support.
NDTV Profit is in Indore, India's cleanest city. But in store, we are going to look after Indore's nightlife, what are the industries, and of course, the industry's budget expectations.
NDTV Profit has travelled all the way to Lucknow. This city is known for its delicious Awadhi food. This city is known for its tehzeeb, and this city is known to be one of the top 5 GDP contributors to India's development.
Budget for Bharat travels to the city of Bengaluru, a city which has given us so many innovators, so many startups. I'm spending time in a startup hub to get a pulse of the city and to find out what the startup founders want from the finance minister.
Coimbatore, a pretty big city in Tamil Nadu, known for industry, known for its textiles and also filter coffee. It's been called the Manchester of South India for a reason, and that's because of spinning and because of textiles. I've got Saurabh Mukherjee as well as Nandita, who is the economist at Marcellus, and we're actually going to be going to a few places over the course of the day.
A very special moment for us as we announce NDTV Master Stroke, the NDTV Art Awards.
NDTV presents the Master Stroke Art Awards, an odyssey of creative brilliance where the masterpiece meets its ultimate recognition.
NDTV bringing this subject forward would have a great integrity of putting it forward where people could understand the importance of art.
This award that is being started, I'm sure is going to be amazing.
Art for India and for Indians is an expression of our Atmanirbharta. It's actually
Good evening. Welcome to The Big Question on NDTV Profit. I'm Vikram Oza, and tonight we're decoding a generation that is already reshaping India's workplaces. We're talking about Gen Z. It's now well and truly in the workplace, and hence we're asking a very simple question. Is India Inc. facing its biggest shake-up yet with the entry of Gen Z? Because the trigger for this is a new survey. It's something that Naukri has come out with. Naukri, of course, one of India's largest job platforms. It's based on the responses that they've collected from thousands of Gen Z professionals across corporate India. And the findings challenge some deeply held assumptions about the workforce in India Inc. For one half of Gen Z, the work-life balance matters as much as the salary does. When it comes to career growth, for a clear majority of Gen Z working in corporate India, that doesn't translate in promotions. It means learning new skills on the job. And recognition for over 80% of the respondents in that survey is not praise, is not applause. Gen Z employees, they want real opportunities to grow. That's what they're asking for. And the pressure points are telling. A lack of work-life balance and stagnation are on top of that list of mental health stressors. Not micromanaging bosses, no. And if growth stalls, Gen Z is not the kind who will wait by the sidelines, waiting for things to improve. According to this research, 1 in 7 is going to quit within a year, and over a third are going to find their own path in 3 years. They'll be out of that entire company that's not giving them the opportunities or that work-life balance. And yet companies are pushing back. Hiring bosses are flagging readiness gaps with Gen Z in the workforce. They complain about their short tenures, the short stints that they do. Some of them are even calling the young hires unprepared for the job. And all of this is happening at a time when average job stints are shrinking to just over a year, and attrition is hitting generational highs. So the question is, where is the disconnect? Is Gen Z getting impatient, or is corporate India still designed for a different era, that they haven't done the catch-up just yet? Are workplaces rewarding loyalty and the time served, while a new workforce is asking for skills, for fairness, for transparency, for flexibility? And that's the essential question. And now that AI is coming into the mix, it's really changing that entire picture as well. It's tough for some, it's tougher for some others as well. So how is that going to shake up India Inc.? Are we prepared for the younger workforce, the way that they aspire for growth? Is our corporate ecosystem going to deliver that? That's the important question to us. Let's take you across to the panel, and they're joining us on the show today. Let's introduce you to them. Sarabjit Singh is joining us. He's founder of Easer. Now, that's a platform in the buy now, pay later business. Along with him, we have Prateek Vaidya as well, the Managing Director and Chief Vision Officer at Karma Management Global Consulting Solutions. Sadia Saeed is also with us, and Sadia is founder, Chief Psychologist and Mindfulness Trainer at Inner Space. We have leadership coach Gopal Sejpal. We have a full house. Piyush Bagaria is also in the mix tonight. He's the co-founder of fintech startup Salary Say. So good to have all of you. Sarabjit, may I ask you first? The Naukri report is showing that half of Gen Z is prioritizing work-life balance over everything except salary. So when I look at you as a founder today, is that old idea that long hours means commitment, is that completely outdated now, going by what this research is telling us?
So Vikram, actually, the entire idea of long hours has not gone unless and until something meaningful has been given to the employees. So if there is something big coming up, they have been driven with the entire motive of the organization. And at the same time, if they are looking to, contribute to the entire growth of the company along with themselves, they are okay with it. They are okay to work late hours, come at the flexible timings in the morning. But yes, even the organizations like ours and the new ones which are coming up with the younger entrepreneurs out there have to cope up with the new norms and not rely on what they have already had an experience along,
Piyush, do you agree with what you're hearing from Sarabjit? This data is also showing that Gen Z is now increasingly tying growth to fairness and pay transparency. So now one wonders whether that opaque salary bands, the slow corrections, are those now deal breakers for retention when it comes to Gen Z in the workforce?
Absolutely. Vikram, thanks for having me on the show.
I am personally a big fan of this Gen Z generation. 80% of my team is Gen Z. I think it's very transparent and great working with them. Plus, we also empower a lot of leading Indian corporates to improve their benefits and relationships with their Gen Z workforce. What we see across the board is that this is a generation which, unlike let's say previous generations, has multiple opportunities and choices, and they will value their growth and connection over other things. Right, so they will not be stuck at a place which is not valuing them or which doesn't serve them just out of stability. So they will, they want the best for themselves, and leading organizations are going out of the way to make it happen for Gen Z. I think that's the way I see industry evolving.
Prateek, what's your point of view on this? 57% defining career growth as upskilling right now. And that is the new mix that's happening as far as Gen Z is concerned. What's your take on what you're hearing so far?
See, first of all, Gen Z is not allergic to hard work.
Yes.
They're allergic to, like a wasted work. They still want growth, but they define it in skills, exposure, meaningful projects, not just titles. They don't just want titles. So if India Inc. Keeps rewarding hours in hierarchy, retention will become the cost of the mismatch. That's what I think, So growth is equal to, I would say, skills and mobility, but just not promotion. And they just want also work-life balance as well. That's very, very important. And I saw the report as well of the Naukri. So they want predictable boundaries, but they want project works and not reduce ambition. That's very important. And yes, lastly, they just want recognition so that opportunity and exposure is there, just not theatrics of praises. That's what my take is.
So now the question is whether organizations are still rewarding time served instead of the skills acquired. And it's going to be an important ask for many organizations. Sadhya, when this lack of balance, the lack of growth, they top Gen Z's mental health stressors, what does it say about how pressure and how burnout, how they've changed for Gen Z as a generation in a workforce?
First of all, I think from a contextual perspective, even just looking at the larger picture, I feel that the mental health awareness, both awareness of mental health, awareness of how mind and body work together is a little more stronger in Gen Z, and they are forced to kind of notice their own anxieties, their own panic, come up and say, this is not working for me, I'm feeling anxious, vis-a-vis the previous generation who would say, okay, these are just part of the game, you just have to play the game, you have to go through the anxiety, you're sleepless, okay, you just have a pill or you have something and you just move on. So I feel it's both. One is, of course, we see more anxiety, more unsteadiness. With time, I think it also has to do a lot with the extent of virtual reality everybody is engaged in. But on the other hand, I also feel that there is more awareness and more assertiveness around the fact that I need to be mentally healthy and I need to be well. And that has led to this greater demand for balance in life and to do what makes sense, what gives meaning. I think they've also looked at the previous generations and learned that just working until you're 40, 45 like crazy, just looking at material growth and then not looking at physical, personal growth and meaning in life leads to a lot of despair at some point, also a lot of breakdown in mental and physical health later in life. So I think they've been seeing a lot of things, learning and taking
Mr.
decisions.
Sejpal over here, Sadhya, is someone who is mentoring a lot of corporate leadership. So, Mr. Sejpal, when you look at the kind of numbers that are presented in this Naukri report, one part of it is saying that if 81% want recognition through real growth opportunities, they don't want praise for it. They don't want applause for it. Managers need to create leadership models for them that are designed for them. They want to be recognized, yes, but they want to be recognized through opportunities. Do you see that? Is that something that becomes part of what leadership at corporates are now looking at trying to create even?
Yeah, I mean, the opportunities in which area? Opportunity in the lateral growth, maybe yes, but generally most of the corporations, most of the companies, they are giving them the horizontal growth. which is not palatable to them. Their designation change, but neither their pay package increases, nor their responsibility increases, nor their team number increases. And they are not happy with that kind of situation because they are born leaders, and most of them come from the B schools where they are taught to lead teams, build teams. And here, when they come and some of them are asked to work in silos, which is not palatable to them at all, they would like to much rather leave that organization and create their own. Because most of the Gen Z people are, wanting to be independent. In fact, when I mentor leaders, I tell them, give them an independent department, division, give them a team and let them do it. And while quoting Dr. Stephen Covey, who says, tell them what you want them to do and then leave it to them. Don't supervise their methodology. What they hate is the micromanaging part, which most of the leaders are still, wanting to do, or they still do it, which is resented by these Gen Z people. That's my opinion.
Yes.
They are career-oriented. They want growth,
Yes.
but in the lateral way and not in the horizontal way.
So do you find that, Sarabjit, in the Gen Z that you hire, that you work with, that they are entrepreneurial in nature? So when they're talking about opportunities, perhaps they're looking at opportunities where they're going to learn the tricks so that they can grow into entrepreneurial roles in the future. Is that the kind of shift? And if India Inc. has to get the maximum out of them, they'll need to give them that without micromanaging. That's the word we're getting from Mr. Sejpal. Do you agree with that?
So I actually agree with them from a point of view that when we hire, the basic qualities that we look into an employee that comes on board is how is his reasoning skills with us, because a lot of things which has been now simplified because of AI, the kind of work that we were putting up for hours and hours, specifically in tech and regulations otherwise, has now been shortened up. So the workforce has shortened up. At the same time, these all new generation employees which are out there are seeking for opportunities to outshine and not actually just come to office every day and go back home. So they also prioritize their work balance, not only by having a different perspective towards life or works or priorities, but they're also looking forward to creating something which is more meaningful for them at work, something that they look forward to while going every day. And that's where it all creates.
So absolutely, one understands exactly what they're thriving for at this point in time when you consider what Gen Z is aiming for, when you consider the short job tenures. The highest attrition rates are now. Many companies are calling them unhireable as well. So is that a Gen Z issue, you think, Piyush, or do you think that this is a broken onboarding system? There is an expectations gap between the hirer and the hired in Gen Z.
Vikram, I think, Indian organizations will need to adapt because, this is the generation, I'm sure, generation Alpha, Beta, whatever comes after Gen Z. It's not going to be an easy ride go forward. So what we see is, a lot of forward-leading thinkers, like this panel spoke about, they need to fix the system. In a way, all companies also want employees to bring their best, seek meaning in their work, which is what Gen Zs want. So there is no difference of intent. I think it's just rewiring the existing, ways of work and resetting everything, which is more palatable to both the organization and the Gen Z employee.
But Piyush, salary, say, is the organization that you run. How important is the salary today? The report is showing that 14% of the people who are responding to this survey, they are saying that they are going to quit within a year if there is no growth. 37% are going to quit within 3 years. So how much of that kind of churn that the report is talking about is actually going to be driven by the progression or the slow pay progression? How much of that is a factor?
No, absolutely. I think, for this generation, salary is a given. I think, they want state-of-the-art, let's say, benefits on top of their salary, which is personalized, customized, using AI and, other technology pieces. So I don't think, salary is not the top priority in their mind, like the survey also says. They take it as a given. They are not willing to wait. In fact, many of Gen Zs we work with, they are happy to wait out of jobs even for a few months because they know and they are confident that, if they have the right skills, job is, going to come to them no matter what. So that's I think is a big difference between previous generations and Gen Z.
Well, the costs of everything are going up, and perhaps that's another reason, because when you're talking about work-life balance, you're also talking about opportunities where they are able to spend the kind of money that they make by doing the kind of work that they do in a way that is going to enhance their lifestyle. Prateek, only 11% of Gen Z is expecting to stay long-term in their current role is what this survey indicates. So do companies even know how to design modern career paths anymore to be able to kind of retain them?
See, organizations need to understand that salary for the Gen Z may be getting in the door, right? But it does not make them stay. What retains Gen Z is the momentum, the skills, the meaningful projects, and a manager who invests in their growth. That's very important. See, Gen Z is not a problem. Workplace design, as Piyush and other friends of mine, they told, is a problem. People are still working on the old organization charts and titles and everything. That needs to have a complete refurbishment, which is really, really great. If you really want to retain Gen Zs, okay, no problem. They may go 1 year down the line. They may be entrepreneurial nature. So are you trying to engage with a fixed, with variable, and maybe some of the companies with ESOPs? That's how you'll be able to give them. They are okay with the challenges, but the money is not the criteria. The challenge in their work and what you give them upskill. That's what they want.
Mr. Sejpal, what's your take on this? Because retaining Gen Z talent seems to be a huge ask for India Inc. Yes, you'll get them in, but how are you going to keep them there? That's the question. So what do you tell the corporates when you do your training?
Two things I tell them. One, let them have their voice. Let them have their voice not only at their individual division level, but also at the board level. When their board meeting takes place and they are talking about the upskilling of the people, are they included? Are some of the the real top performers, are they included in that those meetings? That is, my suggestion to them is include them, ask their opinion, then draw up the career path. Those earlier career paths are no longer valid in today's context. I mean, I don't know many companies who are actually teaching them AI models and all.
Right.
What they are, Gen Z is learning, they are learning on their own. Structured programs are not designed or really taken into account. Second part is that old performance management or performance appraisal systems. Filling up the form once a year at the end of the year and without even sometime telling them what is expected of them is still in vogue, and that is killing the Gen Z people. I generally recommend to the corporate world, I said, look, call them on a monthly meeting. Tell them what you want or agree with them, partner with them and say, this is what is expected of you during this coming month. And then at the end of the month, sit with them, how much has been achieved, what came in the way, and how, and not in the written format. Do it one-to-one in a communication system. And today AI can interpret that, make notes of that, and give you commentary on that. So what is the reason? Why are you doing the form filling here? It's not required at all in this current scenario.
Saripjit, this is an important piece, right? To be able to kind of do this interaction with the management for Gen Z employees, having it face to face, not waiting for an entire year, fixing your KRAs and then testing whether you've done enough or not to be able to give them the salary hike. That's the old practice. Maybe millennials were okay with that still, but I'm not sure Gen Z is going to be okay with that. So how do you do that? And constant learning, like Mr. Sejpal is pointing out.
So actually, I agree with Mr. Sejpal because at the end of the day, conversation, involvement, and I also believe the entire investment that the employees nowadays have within an organization is much higher as compared to what was before. And everything earlier was on the CXO levels, and there were organizational processes and methods that were followed. But currently, the current scenario, like salary say, we also have approximately 75 to 85% of our workforce, which are the new generations. So their involvement in the entire organization, what are the milestones that we're going to achieve, how are we going to go from there, that drives them at the end of the day. And that what's keep them sticking to the company, at the same time driving the common goal where the organization and the employees grow together. And unless and until it's one-on-one, unless and until the communication is clear, the things don't move that way. The earlier generations had different priorities. Earlier generations had different mindset towards a stable income source, wherein here, again, it is like that.
So communication needs to be
here-
clear. Sadhya, that's one takeaway. Transparency is very important for them. In fact, the surveys also are showing that 65% they value transparency. They want fairness above all company values. They may not care for too many other values, but they want fairness. How damaging is unclear communication? Sarabjit is pointing that out, but when it comes to roles, to their growth, to the kind of pay, the kind of hikes that are being given, all of that is important to mental well-being and how a Gen Z employee is going to enjoy staying in an organization or not, isn't it?
Absolutely. I think it boils down to trust, fairness and trust in the management, in the system, and whether the system is actually rooting for you or not. And, given the opportunity, I would like to say everybody, even in the previous generations, needed this. But like Sarabjit said, we settled for stable sources of income and other priorities which were more important at that time. And now that those priorities are not there for this generation, they're looking for exactly what anybody looks for: fairness, some equity in the system, trust in the system being interested in their growth and growing together with everybody. So ultimately, if these are the things that everybody has ever demanded, meaning in the workplace, is something which I feel we'll have to bring to the workspaces now.
Yes. So going ahead from here, now Piyush, Gen Z is also the most AI using and AI anxious generation. How should companies rethink their pay or approach to productivity, reskilling in an AI-shaped workplace?
Vikram, I think, India historically has been at the forefront of, taking benefit from any technology change globally. And AI is possibly one of the biggest realities of our time. So we need to design systems. I think corporate companies need to innovate so that, we don't fall behind and take all the advantages. I think, almost all Gen Zs we know, they are digitally very, very savvy. AI is something, they are investing in at their end. It'll be great if, companies also contribute to that skill building initiative. Increasingly AI agents will, as much be a part of our work culture as, humans in a way. So,
Sarabjit,
the way work will
yes. So if Gen Z is going to go growth hopping, they may not go job hopping, but if we want them to go growth hopping even, what's the single biggest change that founders like yourself, like CEOs as well, what kind of change must they make immediately to ensure that they get the growth and they don't go job hopping?
I think it's more of the recognition among the organizational which will thrive the Gen Zs to actually be and stick to the organization for a longer period of time. Earlier, we had seen employees, working for companies for like 15 years, 10 years, and so on. But nowadays, the span has gone down to anywhere around the max that I can expect now is around 2.5, 3 years. Even if you have been taken care well. So at the end of the day, I think on the systematic level, a lot of feedback is what will be now replaced with feed forward. So a lot of recommendations on what has to be done, how it has to be done, has to go from the organization management level also to the employees.
Yes.
And they will then improve from there and then get wasted in your company. And that is what we look forward to also. We want our employees to be wasted in our goals and then move forward from there.
Mr. Sejpal, I'm going to come to you for your final thought on this. Is this really about Gen Z, or do you think corporate India is facing its biggest leadership and workplace reset that may not have happened in decades?
There is nothing wrong with the Gen Z. They are absolutely right in their manner, and their whole life is ahead of them. They have come to this place for growth, for development, for capacity building, which to some extent the B schools had given it to them, most of them. But now with the AI coming in, they would like to use that knowledge in the workplace for two reasons. One, of course, for their self growth and glory, and why should their name not be in the world news and only limited to one particular company or one particular country? They want to be globally recognized, And secondly is that they don't want too much of control over them. I mean, okay, you tell us what you want us to do, and we will do it the other way. Whether I do it through AI or whether I do it with my own developed mind, leave it to me. And then, I am with you. I would like to continue with you.
Right.
When they talk about the work-life balance, the only thing they have that if the office timing or whatever timing out there is closing at 5 o'clock, let me go home at 5 o'clock. I have a girlfriend waiting, or my wife waiting, or my family waiting. I have young children. I have to take care of them.
Yes.
And you want me to, pay by the, light I burn in the office.
Right.
Those were the days when, I was assessed.
Right.
How many hours I put on the job and I was recognized a good worker or a ordinary worker.
Correct.
But today, Gen Z doesn't want all that. I will do that thing in lesser time than you were doing earlier. So they say, Mr. Sejpal, leave it to us and we will do it our way. You want the result? Here are the results. Be result oriented rather than
Yes.
oriented.
So it's quite clear. It's quite clear from the data and the discussion that we've had, Mr. Sejpal, that Gen Z is not rejecting work. They are rejecting outdated work structures, if you please. They're asking for balance. They want transparency. They want to enhance their skills. They want fairness at the workplace. And they're willing to walk away if they don't see it. And the question for India Inc. now is no longer whether Gen Z is going to change the workplace or not. That's already happening. The real question is how quickly companies are willing to adapt to this. And that's going to be an important ask of India Inc., considering the growth path that we are on. My thanks to Sarabjit Singh, Piyush Bagaria, Pratik Vaidya, Sadhya Saeed, and Mr. Sejpal. Thank you for joining us with your insights tonight on a very important subject. And indeed, we'll keep the big questions coming here on NDTV Profit. We are talking about Gen Z, several issues related to it, and many more on NDTV Profit. I'm Vikram Oza from me and the team. Thank you so much for joining us this evening. Bye-bye.
The first Indian news channel at the World Economic Forum at Davos. 21 years at the heart of the world's most influential dialogue.
Continuing to make sure that the poorest are not forgotten.
Big enough, brave enough, bold enough to face the critics.
We've been doing more and more improvements.
We are the fastest growing amongst the major economies.
Both of us are interested in these.
Young girls aren't in school because they're scavenging for water for the family.
We need to get out of the way and into the work of breaking open access for each and everyone.
Now, India's most trusted news network returns to the Alps with its most formidable editorial voices. NDTV Ignite at Davos. This budget, India speaks from every direction, from metros to mandis, from factories to farms. NDTV Profit reports from 36 states and union territories. With our ear to the ground and our pulse to what people want. Watch Budget for Bharat, only on NDTV Profit. What Bharat wants, what Bharat expects. We are listening. Before the Finance Minister speaks. Budget 2026, the growth agenda. Only on NDTV Profit, for your profit.
A very special moment for us as we announce NDTV Master Stroke, the NDTV Art Awards.
NDTV presents the Master Stroke Art Awards. An odyssey of creative brilliance where the masterpiece meets its ultimate recognition.
NDTV bringing this subject forward would have a great integrity of putting it forward where people could understand the importance of art.
This award that is being started, I'm sure is going to be amazing.
Art for India and for Indians is an expression of our Atmanirbharta.
It's actually quite a formidable jury, so I think we'll reveal a lot more as we go along.
This is an amazing platform, I think, today what you're doing.
Honoring the masters who define our creative landscape. Coming soon on the NDTV network.
my team, our new auto show is ready. Now we need a promo. Something cool, something sharp.
Well, I'm sure we'll be having outstanding reviews, solid suggestions,
Expert advice. The latest trends. It's a lot simpler. We'll help people make the right auto decisions. It's got the cool stuff, geeky stuff, serious stuff, all of it, so that you can discover, decide, and drive. I'm Siddharth Sharma and I am your Automate.
New year. New power panel. India market open. Now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock. With a table thumping buy.
And when the street wants the levels, he brings the chart.
Charts speak the truth, and I deliver the levels with no frills.
Parag Thakkar and Kush Bohra are now part of the morning crew with Tamanna, Neeraj and Alex. Same show, sharper voices. Every morning on India Market Open, your favorite market show just got better. On NDTV Profit, for your profit.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversation. And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they
Hello and welcome. You're watching Market Express. I'm Himakshi Bahuguna. Now let's get straight into the show and see how the markets have fared today. So it was a tepid day of trade on the Dalal Street today as volumes remain low with Sensex expiry at play. And Nifty has found crucial support at 25,600 levels for the second consecutive session as the index has ended with minor cuts below 25,700 levels. Broader markets, if we talk about, have posted a relatively better show as both the small and mid-cap index has outperformed the benchmarks. And talking about the sector, so it was a mixed day of trade, as the metals and also the PSU banks have seen fresh buying. And if you talk about Nifty metals, so that has emerged as the top gaining sector for the day. While on the losing side, so realty, IT and auto counters have witnessed some sort of selling pressure there. Now let's look at some stocks that were buzzing away in trade, and railways have stolen the spotlight as strong buying and heavy volumes have signaled aggressive pre-budget positioning there. Investors are betting big on the infrastructure allocations with technical charts flashing bullish signals across the leading railway names. Now the sector's momentum is fueled by expectations of the fresh capex announcement and also modernization plans in the upcoming union budget, and traders are riding the rails here, anticipating policy-driven tailwinds that could keep this rally on track. And in short, if we talk about railways, are the market's express train today, so fast, packed, and also heading for a promising destination. Viewers, it's record highs yellow for the metals complex here, Gold, silver and copper all are scaling record highs as investors pile into the hard assets, betting on lower Fed rates and also China trade revival that pushed its surplus to $1.2 trillion in 2025. Now, tin is shining among the base metals with a near 6% rise, while silver traders await the outcome of a US Section 232 probe that could, slap tariffs on the white metal. And elevated trading volumes on, COMEX and also Shanghai signal a frenzy even as oil cools near $65 after a 4-day rally with oversupply fears offsetting Iran concerns. Meanwhile, Bitcoin, joins the risk rally here, hitting a 2-month high. And sparkling silver prices are giving Hindustan Zinc and Hind Copper some bright shine. With silver hitting record highs, the metal now contributes 20 to 25% to revenue and also hefty 35 to 40% of the EBITDA when it comes to Hind Zinc. So every